So let's talk about the trade desk. You've probably heard of them, an ad tech giant that was, for a long time, an absolute darling of Wall Street. But now, now it's at the heart of a pretty big stock market mystery. Let's get into it.
And this is where the story really kicks off. Look at that number, a drop of nearly 72% in just 1 year. Wow, that's not a dip, that's a full-on collapse. And a number like that, it just makes you stop and ask, what on earth happened?
And that's the central question we're going to try and unpack today. How does a company that was flying so high, seen as this huge innovator, suddenly find itself in this position? Was there some kind of sudden crisis, or, were the warning signs there the whole time?
To really understand what's going on, we've got to look at what actually triggered this freefall. The stock price, that's just the symptom. The real story, well, it starts inside the company itself. Okay, check out how fast this all went down. A new chief financial officer, Alex KL, is brought in. Seems normal, right? But then, just 5 months later, he's out, gone. And then an interim CFO is put in his place. For investors, that kind of revolving door in a super critical leadership role, it's a massive red flag. It just screams instability.
And that instability, it wasn't just a small ripple of concern. No, it opened the floodgates for what you could call the case for panic. This isn't just about a few bad days in the market. It's about a whole collection of bearish signals that all seem to suggest something is fundamentally wrong here.
And that red flag, it started a chain reaction on Wall Street. First, you had Rosenblatt, then Truist Securities, then Citizens, boom, boom, boom. One after another, analysts started slashing their price targets and downgrading the stock. And when all the experts start worrying at the same time, you can bet the market is going to listen. On top of that, the numbers themselves started adding fuel to the fire. See, for a company like the trade desk, growth is absolutely everything. In 2024, they were posting a really healthy 26% year-over-year growth. But by the third quarter of 2025, that slowed down to 18%. And for a tech stock that has this premium price tag, deceleration is a word investors just hate to hear. And if the internal issues weren't enough, they're facing some serious heat from the outside. You've got Amazon and Google muscling into their territory. And then there's the big one, Google's plan to phase out third-party cookies. This is a massive existential threat to the whole open internet advertising model that the trade desk basically champions.
So you put all that together, the shaky leadership, Wall Street's panic, slowing growth, and giant competitors, and you get a really clear, really loud signal from the technical data. The charts, the moving averages, all of it is pointing firmly down.
But is that the whole story? Is it really that simple? Let's, pump the brakes for a second, because there is a completely different narrative, a powerful counter-argument bubbling just beneath all this panic. We'll call it the case for patience. And it all starts with this one number. For over a decade, the trade desk has kept its customer retention rate above 95%. Just let that sink in. In the crazy competitive, fast-moving world of ad tech, their core customers just don't leave. That's not just loyalty, that's proof that their service is deeply embedded and incredibly valuable.
So remember that whole problem with Google and the cookies? Well, it turns out the trade desk isn't just sitting back and watching it happen. This right here, UID2, this is their answer. It's this huge, ambitious open source project to build the next generation of ad tracking, one that's built around privacy and, crucially, doesn't rely on Google. This is their big strategic play.
And the innovation doesn't stop there. Their Kokai AI platform, it's delivering massive efficiency gains for advertisers. And they're not just playing in the future of advertising, they're trying to build it. They are going all in on connected TV, which is the fastest growing part of the market, by launching their own operating system, Ventura. This isn't just some small update, it's a huge move to become the central hub for TV advertising.
And all of that leads to this just stunning piece of data. While the market has the stock priced in the low 30s, a discounted cash flow analysis, which is a way to estimate a company's real value based on future earnings, it calculates an intrinsic value of over $100 per share. So this suggests the stock isn't just a little cheap, it could be massively undervalued.
So now you see the problem, right? We have two incredibly powerful, totally compelling, and completely contradictory stories about the same company. And investors, well, they're caught right in the middle of this tug-of-war, just trying to figure out which story is the real one.
This is the question. This is what every single investor looking at this stock is asking themselves. Do you believe the story told by the crashing stock price and the panicking analysts? Or do you believe the story told by the super loyal customers and that strong fundamental valuation?
Let's just lay it all out, side by side. On the one hand, the bearish case, a high PE ratio that suggests it's overvalued, technical charts screaming sell and slowing growth. On the other hand, the bullish case, that crazy high DCF value, a decade of amazing customer retention, and a powerhouse portfolio of future-proof tech. I mean, they can't both be right, can they?
So this stalemate, this tug of war, it can't last forever. Something has to give. And it turns out there's a very specific date on the calendar that might finally break the tie and force the market to pick a side.
All right, so you're going to want to circle February 18th. That is the day the company drops its next earnings report. And this is a huge moment. The options market is already pricing in a potential swing of over 12% up or down. This report could be the thing that either confirms everyone's worst fears or validates that whole long-term vision.
This really leaves investors in one of three different camps. Are you a short-term trader, looking at all that negative momentum and staying bearish? Are you a midterm watcher, kind of sitting on the sidelines waiting for a clear, positive signal? Or are you a long-term believer, looking at this low price and seeing a massive buying opportunity?
And so we end right back where we started, with a big question. Is this a company in a terminal decline, a real moment of crisis, or is this one of those rare chances to invest in a market leader at a time of maximum fear, a true moment of opportunity? For now, the mystery of the trade desk continues.